Most people chasing AI plays are staring at the wrong screen. Everyone's obsessed with data centers, GPU shortages, and cloud compute. But there's a much quieter bottleneck that's about to become the loudest problem in tech: your home internet. The cables running into your walls right now simply cannot handle what's coming. Network traffic is projected to explode by 600% over the next decade. And nobody is talking about who actually fixes that problem. Well, almost nobody. There's a company called Harmonic, ticker HLIT. And what they've quietly built is essentially the VMware moment for cable internet. Just like VMware let companies ditch expensive physical servers and move everything to the cloud, Harmonic's software platform called COS lets internet providers like Comcast and Spectrum completely rethink how they upgrade their networks. Before this existed, upgrading broadband speeds meant buying $500,000 hardware units called CMTS chassis, building out huge facilities near neighborhoods, and scheduling nightmare maintenance windows just to swap out physical components across dozens of locations. It was slow, expensive, and brutally disruptive. Harmonic's approach? Eliminate all of that. Their COS platform shifts all the complex routing work to cloud providers like Google Cloud and replaces those giant chassis with a small router they call the Pebble, literally book-sized, that just translates digital signals from fiber into the analog signal your copper cable needs. The end result is a 40% reduction in total cost of ownership for cable companies upgrading their speeds. And instead of physically touching hardware at every site, providers can push a software update and upgrade their entire network with a single click. That's not incremental improvement. That's a fundamentally different business model for the whole industry. Now let's talk about what the numbers actually look like. Their most recent earnings showed revenue growing 43%. Because this is a software-driven business, expenses barely moved, which means operating profits in the broadband segment jumped 115% year over year. Their order backlog grew 87% to $582 million, and management raised full-year 2026 guidance to $485 million. That's 31% growth. For a company trading around 30 times earnings, that's not bad at all. Looking out to 2030 in a bull case scenario, if Harmonic holds on to roughly 85% of the cable virtualization market, that's around $850 million in revenue from cable alone. Add fiber into the equation, where the total addressable market hits $2.7 billion, and even a 15% share there gets you another $450 million. Combined with expanding net margins toward 25% as the software business scales, you get to a valuation somewhere around $9.7 billion, or roughly $91 per share. That's real upside from where it sits today, but here's where it gets complicated. There are two risks you cannot ignore. First, customer concentration. Comcast and Charter alone make up 58% of Harmonic's revenue. These are cyclical businesses, and Charter has already told the market that their capital spending peaks in 2026 and tapers off through 2027 and 2028. That's a headwind that's coming whether the technology is great or not. Second, fiber is a different fight. Harmonic owns roughly 98% of the cable virtualization market, but that's because they spent 7 years building this side by side with Comcast. In fiber, they're walking into a competitive space against players who already offer full turnkey solutions with their own cloud-native software. It's not a guaranteed replay of what they built in cable. On the technical side, the stock has been strong, up 64% over the past year, price sitting well above both the 50 and 200-day moving averages. But momentum indicators are flashing some caution, with the stochastic oscillator touching overbought territory. Analysts are sitting mostly at hold, with price targets clustered between $15 and $18. The bottom line? Harmonic is a genuinely great business solving a real infrastructure problem that matters for AI, for residential broadband, and for the millions of people on Comcast and Spectrum today. The platform works, the margins are excellent, and the leadership, CEO Nimrod Ben-Natan, who actually built this software from the ground up, knows exactly what he's doing. But buying a cyclical company at the top of its upgrade cycle is a risk that's hard to ignore. The smarter move might be watching how 2027 unfolds before pulling the trigger. If you're already in it, the story is still intact for now. But getting in today, you're buying excitement, not a discount. And in investing, those are very different things.